Welcome to the webinar, Raising Capital in Uncertain Times. If you have questions for me, just drop them in the chat and I'll either address them during the presentation if they fit into the different sections that I'm talking about, or we'll hit them at the end. So as I mentioned, I am Andrew Davis. I'm the Director of Investor Relations for PassiveInvesting.com. That is my lovely wife, Isabel. We've been married for almost 9 years now, and we live in Asheville, North Carolina with our very fluffy dog, Piper. And so when I'm not working, when we're not working, we love being here, going for hikes up on the Blue Ridge Parkway, eating good food, checking out one of the breweries. And we also love to travel. So we just got back from an almost month-long trip to Scotland and Ireland, and that was a really amazing experience as well. And then my background is a real mix. And so my career, my W-2 for a very long time was in consumer packaged goods, working in the lawn garden industry. But I always had a fascination and a love for real estate investing. And for many years, it was my side hustle. And so before I ever came to start out, I started out at PassiveInvesting.com as an individual contributor, as an investor relations consultant or associate. And then over the last almost 2 years now, have grown to where I have a team of 5, 6 working for me, working with me to service our 2,000 plus investors. But before I did that, I started raising capital for my own deals. And so my first deal ever was a single family flip that I found and put together a pitch deck and went and solicited a bunch of people to invest in it, and was able to raise about $150,000, $140,000 for that first deal. And that really opened my eyes and my mind to the concept of partnerships and capital partnerships. Robert Kiyosaki would call it other people's money, but just the value or the power and how much you can grow and how far you can go together versus trying to do it on your own. And when this role opened up with PassiveInvesting.com, I was really ready to step into this commercial real estate space and take it to another level. So that's a little bit about me and my background. And then, why would you listen to me? Since I started at PassiveInvesting.com, raised nearly $450 million for real estate investing. So the year before I started, we had raised about $62 million. My first year with the company, we raised about $197 million. And this year we're on track to raise over $300 million. I've taken over 2,500 investor phone calls. I've had countless dinners, meetings, sit downs, etc. So I'm really, really passionate about this topic and really want to dig into this with you and add value to you for this 30 or so minutes that we're here together. So without further ado, let's talk about it. This is titled Raising Capital in Uncertain Times. I just screenshotted these headlines from the Wall Street Journal, from Bloomberg, and this is not going to be a surprise or news to any of you, whether you're an investor or whether you're looking to raise capital. So what's going on? Very, very briefly, as we know, interest rates are at multi-decade highs. I was doing some reading yesterday. The Fed has hiked rates multiple times, and it's highly likely that they're going to hike rates another 75 basis points and another 50 basis points by the end of the year, which are going to send interest rates up on every single thing from 30-year mortgages to commercial real estate interest rates and all that. We have decades high inflation, right? That's what's occurring. That's why the Fed is raising rates at the pace and the aggressive pace that they are, is because inflation's out of control. And so they're trying to stem the tide of inflation. And so far, they've not been happy with the results, which is why they're likely going to raise interest rates another 1.25% or 125 basis points before the end of the year. You would have a hard time pulling out a newspaper or reading the news without somebody speculating as to whether or not we're in a recession. And whether or not we are and how we define that, I'm not here to opine on that. I'm not an economist, but it's on everybody's mind. And the concern is that if they raise rates too high, too fast that it would send the economy into a recession. And of course, what does that do? It results in investor skepticism. So you see volatile stock market that has not been performing well over the recent period. You have more investors that are concerned, that are more skeptical and don't know where to go. And so you have two options as a capital raiser, as an operator, when you see these things and you have conversations with investors and they're saying, I want to sit on the sidelines, or I really want to, just be a little bit more conservative right now. You can believe them and say, you know what, it's not a good time to raise capital. I'm not going to try to grow my business. I'm just going to step back and wait and see what happens. Or, and this is what I would suggest that you do, this is what we're doing, you look for the opportunities. And so what are the opportunities? Number one, investors are looking for reliable places to put their capital. They're unsure about the stock market. They're hemorrhaging money if they're putting it in a savings account. Cash is trash, as they say. So I think my American Express personal savings account is paying me about 2% right now. So with inflation at, say, 8%, I'm losing 6% a year on that money. So most savvy investors are people that want to invest their capital well and grow their wealth. They're not going to want to be in a savings account. The stock market feels too volatile. And with interest rates being where they are, active real estate ownership. And what I mean is somebody starting out sees the value in real estate and thinks, I'm going to go buy a duplex. I'm going to go buy a single family home and rent it out. Well, that is arguably the worst time to be a single family landlord or to invest in single family properties. Why is that? Well, because interest rates are high, the 30-year mortgage rate, and this is for an owner occupied home. So if you're buying an investment property, it's likely going to be in the 7s, makes the cost of capital very, very high. And so I was just looking at a property 15 minutes before I jumped on this webinar with you and saw that it's a $500,000 property with 20% down. The debt service alone is going to be about $2,600, likely closer to $2,800, because that was a quote on owner occupied interest rate or an owner occupied mortgage. When you stack a management on top of that, renovations, repairs, vacancies, all the things that you have to underwrite and account for, that property was going to lose money every month. That is not an appealing investment. And so all these things actually, I think, create some tremendous headwinds to secure capital for deals and to thrive in this time as a capital raiser or as an operator. So how do you do it? I'm so glad you asked. I think there's 3 keys right now to raising capital. They're extend your horizon, be the expert, and stay the course. So the first one, extend your horizon. Couple quotes here that I love. All the returns in life, whether in wealth, relationships, or knowledge, come from compound interest. And then most people overestimate what they can do in a year and underestimate what they can do in 10. So why did I choose these quotes? Right now, if you are trying to put something together to make a quick buck in the next couple of years, or if you've got a goal that, I don't know, say you want to get to $5 million in net worth and an X in passive income every year, and you're thinking, oh, if I just syndicate a couple deals, or if I can just raise X amount of capital, then I can do that. Yeah, you very well may be able to do that. Although I think it's unwise, and I think it's unwise especially now. And one of the reasons that we've been so successful as a group and other capital raisers and operators are successful is because we have a long-term outlook and approach. We're not doing this for the next 2 to 5 years. We actually love this. This is what we want to do for our entire career. And we want to have relationships with the investors that we have today. We want to have relationships with them in 10 or 20 or 30 years. And we want to grow our wealth right alongside them. So the first thing that you want to think about when you extend your horizon is you want to build a long-term outlook and approach. And that applies to your underwriting, which you're looking at for deals right now. It's unlikely that you're going to be able to turn a deal in 3 years right now. You want to look at a 5 to a 7 year outlook. You do not want to plan for a refinance or underwrite for a refinance. A refinance is great. We say it's icing on the cake. The reason being is you have no idea what interest rates are going to be in 2 years, nor do we. We can speculate, we can guess, we can look at historical charts, but planning for a refinance or assuming that, yeah, we might be able to get debt at 6% right now, but in 2 years it's going to be at 3%, and then we can do a refinance and absolutely crush it. You don't know that, and we don't either. So we'll always look at the opportunity to refinance an asset and return capital to investors and get a better cost of capital or better debt service on that asset. But we never put that in our underwriting or our plan, because if a deal is contingent on that, then it's not going to be a very conservative deal. It's going to be too risky for you as an operator and for your investors. Your asset selection is very, very important right now, your market and asset selection. So one of the things and one of the reasons that we've continued to be successful in this market is because we've landed on a more conservative approach, both in the markets that we pick and the assets that we go after. So we're in the Sunbelt markets, North and South Carolina, Georgia, Florida, Texas, Arizona. We've got some properties in Tennessee and Colorado. These are growing markets with great employers and relatively landlord-friendly laws, and so that's attracting a lot of people. The cost of living is relatively low, although it's gone up significantly in a lot of these markets. But they're attractive from a cost of living, from a lifestyle perspective, from an employment perspective, and in most cases a climate perspective. Although Hurricane Ian made Florida and some of those markets maybe temporarily less appealing, but likely not in the long term. So as you're looking at your outlook, your strategy, your approach, you want to be thinking long term in your underwriting, in your refinance assumptions, in the markets and assets that you're selecting, and then also just in when I say you're underwriting, being conservative in your underwriting. And so we build in, we're only looking at fixed rate debt on our assets right now. We're building in significant reserves against any issues that may arise. We stress test our assets down to somewhere between 55 to 60% occupancy. So we know that we can get down to historically unprecedented occupancy levels in our assets and still maintain our debt service obligations and all the operating expenses, maintaining the integrity of that asset and the security of our investors' principal. So that's what I mean when I say, having a long-term outlook and strategy is not the time to try to make a quick buck. Second, compensation. It's very, very easy in this space to look at what you can make first. And a lot of times that can be fee-based compensation. So you can have acquisition fees, you can have guarantor fees, you can have asset management fees, you can have disposition fees. You can build all sorts of fees in. However, and especially if you're an aspiring operator or a new operator, you don't have a number of full cycle deals, you don't have a really impressive track record, you're still trying to get a foothold in the space, I cannot implore you enough to align your compensation in a way that your investors win first. And what does that do? Number one, it communicates to them that you're confident in what you're doing. You're not trying to extract a bunch of fees from them on the front end. You want to make sure that they win first, and then only if they win do you truly win. Now, I'm not saying don't build an asset management fee to ensure the integrity of your ongoing operations, but I would strongly suggest that you reduce non-performance based fees and that you prioritize your investors, especially if you're new in the space. I recently invested in a deal with somebody that's new in the space. It was an alternative asset class, nothing that we're invested in. But as I read through his PPM and his materials, the first thing that caught my eye was that all of his compensation was performance based. And what that told me is that he very much believes in this. He's done his research. He's done his due diligence on this, and he's confident in the outcome. And that gave me confidence in the outcome. And then lastly, goals and planning. So I touched on this a little bit, but when you're building your business, think about the business that you want in 10 years or 20 years and build the framework and the structure for that now. And what that will do for you, and I love this quote from Bill Gates. I should actually put it on my forehead in reverse so I see it every single day, multiple times a day, because I tend to be impatient in the short term. But what that will do for you mentally, and what that will do for you as in your disposition, in your demeanor as you're talking with potential investors, is it will not communicate a sense of desperation, because you won't feel desperate. And so what Of course, we all want $1 billion business in 3 years or 5 years or whatever it is, but that's unlikely. To be totally honest with you, that's a black swan or an anomaly. That is not the experience of most people. So if you, as you're planning out your business and you're thinking about what you want to achieve, extend that timeline out, and then that will allow you to take consistent small steps in the right direction. And it will also communicate to your investors, both from what you say, but also just who you are and how you present yourself, that you have their best interests in mind and you're in this for the long term. Extend your horizon. Be the expert. This is so, so important. And one of the things when I talk to aspiring capital raisers is I say, look, you need 2 things. And a lot of people think I need a marketing platform, or I need a podcast, or I need a portal, or whatever it is. Yes, you're going to need all those things at some point. But what you need is a foundation, is you need integrity, doing what you say you're going to do, and competence. You actually need to know what you're doing. And this is a beautiful time to shore up and increase your competence in the space and become the expert. So how do you do that? Follow the best. You, as a capital raiser, as an operator, you are an investment manager. You have investors that will or are entrusting you with their capital. And so I love to read investment managers, not just in the real estate space, but in various disciplines that invest in stocks, that invest in alternatives, that invest in other equities, whatever it may be. And so, follow Blackstone, follow Dan Handford and the principles of passiveinvesting.com, follow Ray Dalio, follow Howard Marks, Warren Buffett, Jay Parsons, who's a brilliant real estate economist. There's so many great people out there, and there's so much free research out there from the big commercial real estate brokerage houses. If you go to Ray Dalio's company, Bridgewater and Associates, if you go to Blackstone, if you go to Howard Marks, if you read Warren Buffett's shareholder letters, those are a tremendous education in what's going on in the economy and how to think about markets and how things have been. And that will, if you spend 30 minutes to an hour every day reading those reports, reading their research, seeing what's going on, not reading the hyper emotional, pay attention to me news, but really reading thoughtful papers, research, articles, books from people that have been in the space and have been very, very successful. Number 2, narrow your focus. Do not try to be passiveinvesting.com. As I mentioned at the beginning of this call, we're in multifamily, we're in self-storage, we're in car washes, we're in select service hotels, we're in real estate debt, we're in 5 different asset classes or 5 different business categories. Do not do that. We didn't start out in 5. We started out in 1. We started out in multifamily. And to this day, multifamily, we have about 1.3 billion in assets under management. Multifamily makes up nearly $1 billion of that. So to this day, that is still our bread and butter and a key part of our portfolio. And what we did is we mastered that. We narrowed our focus on key markets and asset classes within those markets. We built an acquisitions criteria. We built an underwriting criteria and refined our model. We found a tremendous property management partner. And then we built a team and processes around that. That took years. And now it's on kind of autopilot to a degree. And that's because we have a tremendous team, but we have our systems and processes in place. But the principles at passiveinvesting.com, they took years to build that. So when you're starting out, or if you don't have a huge investor network, and if you haven't raised hundreds of millions of dollars, and if you're watching this, I imagine you haven't, then really narrow your focus. And so what do I mean by that? Pick a market or a couple markets. And then within that market, pick one asset class. And then within that asset class, pick a grade. So for us, we go after suburban class A and B plus class properties in Sunbelt Southeast markets. And so we're only going to be in cities that have a certain population growth criteria, job growth criteria, median household income, and then we're only going after very, very specific assets. And so for you, as becoming the expert or being the expert, know a market. There's a guy who Rise 48, Zach Hapsnestall, I always mispronounce his last name. He honed in on Phoenix, and then he honed in on a very specific multifamily asset class and type in Phoenix with a really great value add strategy. And he's absolutely crushed it. And I could list operator after operator who have narrowed in on a market and on an asset class within that market and then have mastered it. Start there. You can always grow. You can always expand down the road, but narrow your focus to start with. One of the things that you can do too as well is if you do not have a track record, partner with an existing operator. We have a number of joint venture partners that partner with us and bring capital to our deals, and as well as partner with other operators like Rise 48 that I mentioned. And that's a great way to start out, but don't just bring capital to their deals. If I were you, or if I were just starting out in this space and I wanted to joint venture or co-GP with an operator, I would learn every single thing about that deal. I would learn about their underwriting model. I would learn about their selection criteria. I would be on site during the due diligence time with the acquisitions team. I would know the PPM inside and out. I would learn everything I could about that company because that allows you to learn how they're thinking and will help you narrow your focus and your investment thesis. And then lastly, these things, following the best, learning, and then narrowing your focus, they don't matter if you're not communicating well and consistently. And so one of the things, we do these private capital raising workshops where we do an intensive for about 2 days with Dan Handford, myself, and some key members of our team. And one of the things that Dan says is don't go out and try to start a podcast and a webinar series and a newsletter and Twitter and whatever. Pick one thing, pick the thing that you're likely to do, the thing that you enjoy doing. So I love to write and I love to speak. I love doing this. There's other things that are not very interesting to me. So it's unlikely, at least as I begin, that I'm going to do those things on a consistent basis. So pick the medium that you're most comfortable with and that you're most drawn to. And then whatever you do it consistently. So if it's a monthly newsletter, get that monthly newsletter out every single month. If it's a podcast and you're doing a weekly recording, do that weekly recording. Be consistent. So that's number 2. Be the expert. And then last, stay the course. There are a million quotes about persistence, but what is, I think, another really, really great opportunity that's arising right now and will arise is the quote I almost put here was, when the going get tough, the tough get going. But the non-stated part of that is that the people that aren't tough, they get gone. They're going to leave the space. There's been a lot of interest in capital raising, in syndication in this space over the last 5+ years. There's been masterminds and coaching programs, and a lot of people have jumped in because, and this is not everybody, I'm not making value judgments about people. I don't know how they're thinking, but there's always going to be a chunk of people, and oftentimes a large chunk of people, that just jump into something because they think it's going to be easy. They think it's going to be, you just do this, this, and this. You just follow this playbook and you raise tens of millions of dollars for real estate and cue the private jets and yachts. And that's not the reality. And so what's really beautiful about a time like this, where there is volatility, there is correction, times are uncertain, it's harder to raise capital. The people that have staying power, the people that are consistent, that are the experts, that extend their horizon, they're actually going to succeed here. And I anticipate that our group and a lot of other groups that have that strong foundation and staying power, that integrity, that competence, they're actually going to see a significant increase in their investors over the next 18 to 24 months, as a lot of people are dropping out of the space. And so how do you stay the course? Don't look for quantity in relationships. And so, as I mentioned, we have over 2,000 investors that are invested with us. We've raised $450 million over the last 2 years. Great numbers. Don't go after that. You don't need 2,000 investors. You need 100, 200 high quality relationships with investors that can write decent sized checks for your deals. And so whether it's in co-GP relationships, whether it's in partnerships, or whether it's with investors, seek quality relationships where there's true alignment, where you can really sit down with them either in person or virtually, understand their investing goals, and really be able to articulate how you can help them get there. Secondly, sharpen your convictions. This is a beautiful time to really narrow down and clarify what your investment hypothesis or thesis is. And so one of the things that you'll hear about real estate is you'll hear these quotes like, don't wait to buy real estate and wait, or, land can never go to zero, and things like that. And sure, those things both have truth in them, but it's significantly more complicated than that. So this time, and as you go back to being the expert, as you think about the asset classes that you're interested in, or maybe some instincts about opportunities or areas that are not being exploited, this is the time to sharpen that, to drill down on that, to really be rock solid about your convictions. And that is going to give you a sense of calm and peace as you're raising capital, and will also give your investors a real sense of security in investing with you. So it helps you sleep well at night, and it helps them sleep well at night. And one of the things that I love to do in my team, and I love to do, is talk to a nervous investor, an investor that's skittish, or an investor that's a little bit combative or argumentative and wants to sort of challenge us to see, hey, do you actually believe this? Or what about this? What about this data? What about this number? Those are all beautiful opportunities for us to really shore up our convictions and sharpen our focus, and really and narrow down who we are, what our unique value proposition is. And that's true for you as well. And so seeking quality in those relationships, sharpening your convictions, and then staying engaged. Again, what you'll see, I imagine, we've seen as we do conferences, we're sponsors, or we speak, or we attend different conferences. They've gone from maybe a few hundred people being there to thousands of people being there. I have a feeling that that's going to recede as this space becomes more challenging, as economic news continues to be scary and pessimistic. So the best thing you can do is stay engaged, stay going to networking events, stay being plugged in on LinkedIn. If you're have a local investor group, stay engaged with that group. And what you'll see is the people that stay engaged during this time period, those are the people that you want to be partnered with. Those are going to be your investors. Those are going to be the people that you work with for the long term, because this is truly a partnership business. And we would not exist without great employees, without great partners, without great leadership. And so that's how you stay the course: seek quality, sharpen your convictions, and stay engaged in the space. And that's all I have for you today. I'm going to pop in here and see if there's any questions that I can answer in the Q&A. Can you post those expert people in the chat? Absolutely, I will, Amber. So I'll put those in there right now for you. I'll just actually copy it off my list here. I know the formatting's weird. Sorry about that. Thanks, Robert. Any other questions for me? Got that one. Well, y'all, there's no more questions for me. I want to thank you so much for your time today. I want to encourage you wherever you're at in the space. These are tried and true principles that you can use to grow your syndication business, your capital raising, whatever it is that you're endeavoring to do right now. If you scan that QR code, that'll let you connect with me. You can shoot me an email if you have questions. LinkedIn is the social platform that I'm most active on, so you can find me there. Let me see, we got a couple other questions coming in. How would joint venturing with sponsors work? Well, it's a little bit of a, it's probably another webinar, to be honest. Maybe I'll do another webinar about how to joint venture or co-GP with sponsors. But in short, Robert, you're going to want to find somebody that's got a deal, that's going to be the main operator on a deal. They're acquiring that deal, they're going to operate that deal, and then you can come alongside them and ideally get a slice of the general partnership in exchange for bringing some capital, but then also some managerial effort as well. Question. Are you considering development partnerships? I don't know. Send me a note, Andrew@passiveinvesting.com. Thanks, Vincent. Frenchie, Benjamin. I'll post that list in here one more time. If you don't get it, I don't know what to tell you. Blackstone, Dan Handford, Ray Dalio, Howard Marks, Warren Buffett, Jay Parsons. All right, y'all. That's it for me. Hope you have a great day and look forward to staying connected with you.